I think the better data we have as opposed to in the prior past where it was kind of more backward looking.
Right.
This I think is better because one of the big arguments was always that, well, it's not really reflective of the real world. Like prices are going up, they're going up at the department store, they're going up at the grocery store. Why isn't any of that being really reflected? I think this will be interesting to see if we actually get that output.
Can I say one thing that excites me about this is it'll free up the guys who collect the prices to get prices from a more important part of the economy, which is services. We have terrible data on services. It's a huge part of the economy. Seth is nodding his head over there. And the idea that we don't have the price collectors go in and write down tags on sweaters means maybe they can start and get better pricing and better sales data from the service sector where it's more labor intensive to get the data.
Absolutely. I think this is going to be revolutionary. I don't know if you know this, I used to run the statistics function for the Federal Reserve for the whole system, the collection of data from banks. Lots of processes underway there to automate things. I think the same thing will happen across all sorts of different industries, and the technology behind it, like XBRL, could make it so that it's almost instantaneous, almost zero cost once you get all of the infrastructure in place.
Right.
But with the web scraping and the emphasis on even retail, I think we are going to see potentially more downward pressure on inflation as you're.
That's the interesting key here. Is my suspicion, and I have nothing to back this up, is that real prices paid are lower than those being collected at the store. And I think we're going to find less inflation out there than perhaps is being registered.
Less inflation.
Now, I will say people will write in and say that they think their prices are going up like crazy, and it's just not true. But I think there is this incredible downward pressure on prices in general, and that we're going to get more. There's the CPI, by the way, which I think is interesting, getting to the Fed here, Andrew. Look at that upward shift. You did have the upward shift, and you wonder, well, why did the Fed go in December 2018? You went from a 1.6 zone up to the 2% zone, which was their target. And they're like, hey, I'm at target. I got a low unemployment rate. That's why they went. Now it's come off just recently, and we'll see if that trend continues this year.
Okay. Separately, where are you at on these crazy little markets?
So I think, when we were sitting here in December, things look so bleak, but the data was not that bad. Right now, markets have come back double digits.
Right.
I think now it's all about valuation. Okay, the multiple is fair for the market, so it's really earnings that are going to drive the stocks. It's not going to be multiple expansion.
You think multiple expansion is done?
I think multiple expansion for the time being is done.
Okay, so hold on. We had a guest on just yesterday who said, look, if you actually look at where the multiples were pre-December, there are still two ticks to go, meaning I think we're at about 16.
We're about 16. They were about 18.
Argument you could still get to 18. So his argument was, you could talk about earnings all you want, but if you can just get the multiple, but you think that's a bad way to affect the market.
I think given where we are in the cycle, I don't think one should look for multiple expansion. One should look for companies that are going to actually grow their earnings, and with that, you can get actually your price appreciation. If you get the multiple expansion, that's just icing on the cake. So now where we are is look at the sectors and look at the industries that can actually participate where you have better earnings power for the consumer, where they're going to go spend their money. So companies in home building products, the banks I think are going to do well because they're actually at a much lower valuation than the rest of the market. And think of things
banks
where
have been dead money for
a long time. But if you look at where they are at price to book, you look at it on a PE basis, look at it on a well-capitalized basis.
Haven't we been making this argument for years on the banks?
Yeah, and at some point, if you go back to the 90s and the 95 to 98 period, that's kind of where you had to be. So if
you think now is the moment,
Andrew?
I don't know if now is the moment, but I think you want to be there because when they do start doing well and money comes back into a sector, that is, again, the balance sheets are so much better than they were back in 2009.
We got to go, but I don't want to let Seth leave without a quick outlook for the year. What about GDP, and is the Fed going to hike or not?
So don't think they're going to hike, but we have actually been a little bit more optimistic about GDP.
No, you have.
What's your number?
Why you keep coming back?
More importantly is the trajectory. So things are kind of crummy right now.
Yeah.
We think we get to Q2, we're going to be at 2.5, maybe a little bit more. This is one of the reasons why I'm Joe's favorite economist.
You are.
Exactly.
Right.
One of the reasons.
Yeah, so one of the reasons, thank you. So we had a piece that we called The Roadmap to the Rebound, just looking for the data. And so what's remarkable is the previous segment you were talking about oil. Oil's actually a positive. Higher oil prices now at 6.
You see that as a sign of greater demand and
absolutely. We were actually getting worried because rig counts were coming off. A little bit.
Right.
The last weekly data show a turnaround. If you look at the data on shipments of gravel and sand down to West Texas, as it picked back up again, that looks like a pretty sizable turnaround in the economy. And so we're looking at 2.5% for Q2 and Q3, rounding out the year at 2, maybe a hair over.